Good evening.
Good evening.
Okay, so today I want us to discuss on risk management, on how to manage risk. And there are two types of risk which we shall be discussing. That is the foreign currency risk and the interest rate risk. Okay, foreign currency risk and interest rate risk. Okay, and of course we discuss therefore how do we manage those two types of risk? How to manage the foreign currency risk and how to manage therefore the interest rate risk. Okay, so let me go straight. When it comes to the foreign currency risk, okay, as a company, we do say that you will be exposed to foreign currency risk. Let's try this win. What is foreign currency risk? Okay, a foreign currency risk is a chance that as a business, based on your foreign currency transactions that you will be having, okay, you may end up paying more than what you are expecting, than more than what you are anticipating, or you're going to have a case where you're going to be receiving less than what was your expectations. Okay, so it's about receipts and payments. Okay, the risk comes in. Okay, of course, the risk is more towards deviation from the mean, but the concern is more towards the case where we have either you paying more money, okay, than what you anticipating, that is in your home country currency, okay, or you have in a case where you are going to be receiving less than what you are expecting, less than what you are anticipating from a foreign currency receipts. Okay. So what's exchange rate? Okay, exchange rate is simply what's the price of one currency over the other. Okay, I don't refer to as exchange rate. Okay, what's the price of one currency over the other? What's the price of dollar? Okay, for the Kenya shilling. Okay, they'll call the exchange rate. Okay, the price of one currency, the rate at which one currency is exchanged for that other currency. Okay, you show the price of dollar for Kenya shilling. Okay, how much is it? Okay, they'll call the exchange rate. Okay. Generally, there are two quotations, okay, which we can have with the market, okay, we'll call the direct and the indirect, okay. If you give me having a quotation where the home country currency, okay, this case the Kenya dollar, for example, okay, where we quote the Kenya shilling, okay, as the base currency, okay, no, as the price currency, okay, and the foreign currency as what we are buying, okay, what we are selling, okay, then we refer to that, what we call the direct quotation, okay. An example would be a case of the Kenya shilling versus the dollar, okay, the way it is quoted in Kenya, okay. The quotation is $1 is equal to how many Kenya shilling, okay, that's called the direct quotation, okay, the direct quotation, okay. If you have a case where we're going to be having a case of 1 Kenya shilling is equal to maybe 10 Tanzanian shillings, okay, that will become an indirect quotation, okay. If the home country currency, that is Kenya shilling, is one that is it's the equivalent of 1, okay? A 1 of Kenya shilling is equal to X, okay? The last quotation referred to us as the indirect quotation, okay? And I'll say the classic example, okay? In the case of our market here, the case of US dollar versus Kenya shilling, okay? US dollar is quoted as $1 is equal to X shillings, okay? Therefore, the direct quotation, okay? So here I've mentioned two things. We have what we call the home country currency, okay, which is Kenya shilling, okay, and you have the foreign currency being the US dollar, okay. So home currency and the foreign currency, okay. The quotation that normally will be appearing, okay. For example, 1 Kenya shilling, okay, that's $1, okay, is equal to 78 Kenya shilling, okay. Okay, what that means is that what that imply is that you're going to be having a case where, okay, the quotation is 78 per dollar, 78 shillings, okay, per $1. Okay, that's how most of the time to be quoted. Okay, so you take a shilling to be equal to $1. Okay, therefore this in terms of fraction can be equal to 78 divided by 1. Okay, so the one that is on the numerator is what we call the price currency. Okay, this is what we call the base currency. Okay, so sometimes you may have those terms being used. Okay, therefore Kenya shilling is a price currency and the US dollar is the base currency. Okay, so because sometimes you may find those terms being used: price currency, base currency. Okay, so it's good enough to know what if we follow this quotation. Okay, that is 1 Kenya shilling is equal to $1 is equal to 78 Kenya shilling. Okay, this therefore is the price currency. Okay. And this is the base currency. Okay, what are Korean going to be? Okay, Therefore, that's called the exchange rate. Okay, so it's well enough you get to know the direct as well as the indirect quotation system. Then when it comes to exchange rate, you can have three types of exchange rates. Okay, you have the spot, you have the free spot, and you have the forward rate. Okay, what's the spot rate? Now, spot rate is current rate. If you are to go to the market today, okay, and you are to present yourself, to present to the trader or to the bank, okay, with $1,000, okay, what rate is the bank going to give you, okay, in order to exchange that $1,000, okay, referred to as the spot rate, okay, currently in the market, okay, if you are to go and sell your foreign currency, how much, what is going to be the rate the bank is going to be giving you for that foreign currency, referred to as the spot rate, okay, the current trading price, trading rates, okay, for the foreign currency in the market today, okay. Okay, let's take the class example of Kenyan shilling versus US dollar, okay, and the Kenyan shilling versus US dollar, okay. So just to observe the market, I'm not sure what is the rate currently, okay. Let's use the CBK rate, we see USD to Kenyan shilling, okay, 108, okay. Therefore, what does 108 imply? Imply therefore that for every one US dollar, okay, the average price is currently at 108.9, okay, at 108.9, okay. They'll call therefore the spot. But in case you have to go to the market today, okay, maybe this for the central bank more or less, okay. Therefore, the exchange will be equal to, therefore be equal to 108 cash shilling per dollar, okay. Therefore, the spot rate, okay. This is called the spot rate. The now for the fee spot rate, okay, the fee spot rate, okay. Now the fee spot rate will be the rate that will be applicable, or that the markets will be that will be traded at, the rate at which the currency will be traded at in the future, okay. For example, okay, if we are to go to the market tomorrow, okay, the rate will not be at 108, okay, but the rate will be at 108.9, okay, and we will be 108.5, okay. So the rate tomorrow is so-called a future spot rate, okay, because tomorrow is already in the future, okay. But the spot rate in the market is what will the rate then in the market, okay, referred to as the future spot rate, okay, future spot rate. The forward rate, okay, this is a rate that you do agree in advance, okay. For example, if you are a tea farmer, okay, you're going to make sales of tea, okay, and you expect to receive money from your customer in a month's time, okay. So what do? You can enter an agreement in advance. You tell the bank, hey, in a month's time, I'll be getting 1 million euros, okay. So I want to ask to agree a rate to be applied when I get the money, okay. So you agree the rate, you agree on the rate to be applied in a month's time, but you do so in advance, okay. So you as the trader, okay, you as the one who is in need or is trying to hedge or is trying to minimize your risk, okay. So you go to the bank, you go to the trader, okay, inform them of your position, okay. So you agree on the rate that will be applicable in the future, okay. So the rate to be applied in a month's time, okay, is what we refer to as the forward exchange rate. Is what was the forward exchange rate, okay. So the call for the price, therefore, are going to be applicable in the future, okay. So you agree this rate today, but it's going to be applied at a future date, okay. But you agree on the rate to be applied in future today, okay. Don't confuse this two, the spot, the free spot, the forward, because sometimes this can be confusing to the students, okay. The spot is current rate, free spot is the rate to be applied, for example, tomorrow in the morning, okay. Forward rate is the rate to be applied tomorrow if you agree today, okay. That's a key difference. An example, go through this, then we discuss together. Okay, I suppose you've gone through the question, so there's a time to do it together. Okay, so again, in this case for this company, okay, we have an importer, okay, a UK importer, and as well as an exporter. Okay, the exporter is receiving a payment, so this is a receipt, okay, from a Danish customer, and the receipt is in kronas, okay. Therefore, he has this particular exporter has an exposure towards a foreign currency risk because you're receiving in a foreign currency other than your home currency, the sterling pounds. Okay, the same case apply to this importer. You're paying in Japanese yen as opposed to paying in pounds. So therefore, the two of them have foreign currency exposure. Okay. Okay, the quotation given there. Okay, the bank sells. Okay, Danish krona per pound 9.434. Okay, those are the two quotation. Okay, we have got the bid and the ask. Okay, Japanese yen. Okay, to sterling pound 2325, which means therefore among those two currencies, the three currencies, Danish, Japanese yen, the pound is the stronger one, of course. Okay, so let's begin with the first customer. Okay, the exporter is receiving Danish krona. Okay, so begin by the situation is a receipt in Danish krona. Okay, receipt. Okay, it's in krona. You're equal to 150,000 kronas. Okay, therefore, in case you receive the money, then of course you don't forget you need to convert them to the sterling pound because it's just your UK exporter. Therefore, we convert it back to UK pounds. So the question is, do you use the first quotation or do you use the second quotation? Okay, because you have two quotations there. You have the bid. The first one is called the bid, the one that is written sell there, and the other is called the ask. Okay, bid. Okay, and ask. Okay, so you do the first quotation or do the second quotation. Okay, the easiest way, okay, to determine which quotation you use, okay, among those two quotations is you are receiving. So therefore, don't forget the bank must make money. So therefore, the quotation that is going to result to you, well, we should use a quotation that result to you getting less kronas, okay, there's less pounds, okay. Because you're going to go to the bank with your krona, 150,000 kronas, and then the bank is going to give you pounds. Okay, so the bank therefore going to the quotation that is what you get in less pounds. Okay, because you're receiving. Okay, the bank must make profit. Okay, the profit is going to be the difference between the two quotation. Okay, to the bank. Okay, since you're receiving, therefore the quotation that is what you receive in less money. Okay, let's give therefore the first second quotation. Which one? Which one do we use? The first second quotation.
Ask.
Yes, we use therefore second quotation, which is equal to 9.580. They ask. Okay. Therefore, the amount in sterling pound. Okay, the receipt in sterling pound, amount in pound. Therefore, will be equal to 1,000 krona. Okay, we convert because we are dividing. Don't forget. Okay, divide by 9.5380. Okay, how much pounds therefore we're going to get? How much did you get?
15,726.
726.57.
57.
Okay, 50,526.57 color for the amount you'll be receiving in sterling pounds. Okay, you can try. In case you are to divide by the first quotation, you're going to end up getting more money. Okay, because that can happen. Okay, the bank, the trader is there to make money. And the difference is the amount they're going to make out of you. Okay, so in case you have to divide by 9.434, you get more pounds. Okay, which is not the case. Okay, the trader must make profit. That's the easiest way to try. That's the easiest way of trying to determine what quotation you ought to use. Okay. In the next quotation, the next is payment. There's an import here. Payment, it's in yen. Okay, it's in Japanese yen. Okay, how much is it? It's 1 million yen. Okay, it's 1 million yen. But now you are UK. You need to pay. You pay in pounds. Okay, so you go to the bank, ask the bank. Okay, you present your pounds to the bank. If the bank give you the ends in quote, okay, then you can make a payment to your supplier. Okay, therefore, with a quotation, the result you giving more pounds to the bank because you're making the payment. Okay, therefore, use a quotation result you making more payment to the bank. Okay, therefore, the amount therefore. Okay, the amount in pounds, okay, is 1 million yen. Okay, we divide by the first quotation to 3.65. Okay, how much therefore do you pay in sterling pound? 4,000.
910.39.
510.
910.
Or 910.39. 0.39. That's the easiest way of trying to determine because it can be confusing. Okay, most time your examiner is not going to give you the two quotation, but it's good to be prepared. Okay, so for most of the time the examiner is going to give you an average, but it's good to prepare because sometimes in the past he has done that, given those two quotation. Okay, so you might we can get confused. Which one do I use? Okay, the first, the bid, or the ask. Okay, the easiest way. Okay, get to determine what is my position. Am I paying or receiving? If you're receiving, use the quotation. The quotation that is what you're receiving less. If you're paying, use a quotation result you're paying more. That's the easiest trick when it comes to dealing with this question. Any question? Any question? No question. Great. Now, when it comes to foreign currency risk, okay, there are three types of risks that you can be exposed to. Okay, as I had mentioned, don't forget the exposure towards the risk is a case where you have a transaction, and this transaction, like you just done those in that example, is in a foreign currency. Okay, you're either receiving or paying in a foreign currency. Okay, so generally we can classify the foreign currency risk in two classes. Okay, transaction, like the one you just discussed. Okay, where you're making payment to your suppliers. Okay, you are receiving from your customer. Okay, so we call them transaction risk. Okay, then you can call the economic risk, which is therefore the long-term version of the transaction risk. Okay, this is short-term. Okay, this long term. Okay, we must say that the economic risk is the long term version of the transaction risk. Then you have the transaction risk. Okay, this is where in case the books of subsidiary, a foreign subsidiary, okay, we must convert the books of foreign subsidiary back to the currency of the parent company. Example, Equity Bank. Okay, they have some branch in South Sudan. Okay, branch in Uganda. Okay, branch in Rwanda. So at the end of the day, don't forget the books of Equity Bank must be reconciled. Okay, they must be presented in cash shilling. So as you do the translation, okay, as you attempt to translate, you must translate it from, for example, Rwandese franc back to shilling. Okay, so that is you'll be having a case, okay, where we do have a payment, where we do not a payment as per se. You have more of assets than liability. That's a gain. What can happen? Okay, don't forget in the books of, let's say, Equity Bank Rwanda, okay, they are balancing. Okay, by the time they're going to be translated, okay, but by the time after you translate them, quite unlikely they'll be balancing. Okay, so you can have a case where you have more assets than liability. So if you have more assets than liability, for example, 10, and here you have 9, then you have therefore a positive 1 here. This kind of form what we call a translation gain. Okay, that you make. Okay, if you have a case here, they are 10 and liability is 11, here you have a loss of 1. They call translation loss. So as per se, it's a book loss because the books of this company were already balancing by the time they were being prepared. Okay, so it should not be a concern as per se. We call the translation risk. Okay, anyway, let's read the first one. We call the transaction risk. So give me a minute. Okay, sorry for that. So you say that the key one you have called is the transaction risk. Okay, and the transaction risk is the case that you, as a company, you have a payment or you have a receipt which you're meant to make, and you are going to have a case where you either paid more. Okay, if it's a payment that is in your local currency, okay, in your home country currency, or a case where you're going to be able to receiving less. Okay, if the receipt, the risk is you're going to receive less. Okay, what you are expecting and what will be the actual amount we received. Okay, they call the case of the transaction risk. Okay, an example there, go for it, we discuss together. So this example, you have KQ entered contract to buy fuel worth 100,000. Okay, but so by the time of the contract, the price. Okay, so this is transaction date. Okay, this is the transaction date. The amount you meant to pay is 100,000 times the rate 10. Okay, at that time it was 3.7 times 3.7. The amount you meant to pay in cash sharing, therefore, is equal to 6.37 million. The time you're making the settlement, that is settlement date. Okay, the amount is made the same, 100,000, but the rate then have increased. Okay, the cash share have become weaker, so into 1.2. Therefore, the payment you meant to make, therefore, in cash share is equal, so into 7.12 million. Therefore, here you made a loss here. Okay, therefore the exchange loss. Okay, the exchange loss made in the transaction, therefore, is equal to the difference, which is how much?
750,000.
750,000. 750,000. Therefore, here there's an exchange loss made by the company equal to 750,000. Okay, so this is called an exchange loss. This is called transaction risk. Okay, case where you'll be paying more, like in this example, compared to what you are anticipating, compared to if you have to make the payment today. Then you have called the economic risk. You have called the economic risk. Okay, in the case of the economic risk, okay. Now this is, as I mentioned, this is long-term version of the transaction risk. Okay, this is called a long-term version of the transaction risk. Essentially, it is what will be the impact of the exchange rates, okay, on the value of a project, on the present value of cash flows. Okay, if for instance the company has made an investment in a foreign country, okay, an investment in foreign country, or even your home, or even in your home currency, you have a project that is dependent on raw materials that comes from a foreign country. Okay, for example, you as EABL, okay, most of your raw materials, the barrels comes from, let's say, South America. Okay, and you don't pay in cash, you pay in dollars. Okay, so therefore, your investment, okay, your projects, okay, will be affected by the rate of cash versus the rate of cash versus the US dollar. Okay. So in case the cash becomes weaker, you pay more to your suppliers. Okay, if cash becomes stronger, if cash becomes stronger, then you pay less. Okay, it becomes therefore positive benefit to the business. Okay, so what's the impact? What's the impact of the foreign currency exchange rate on the value of the investment? Because in case the cash becomes weaker and weaker as time goes by, it means you pay more. It means you have more cash flow. Okay, therefore the NPV is reducing. Okay, because you are being therefore because you are paying more in your local currency. Okay, if the currency becomes stronger, okay, the currency becomes stronger compared to US dollar. Okay, to me, therefore your payments, for example, are decreasing in terms of currency because of the favorable movement in the exchange rate. Okay, therefore the cash flow are increasing. Okay, the cash flow are increasing because the outflows are decreasing. Okay, that implies therefore you didn't have an increase in the company NPV because of the favorable movement in the foreign currency exchange rate. Okay, so the impact of the exchange rate on the value, on the present value of cash flow to be received from an investment, referred to us as the economic risk. Okay, the positive impact or even the negative. Okay, the impact to be having on the cash flows, the present value of cash flow to be received or to be paid for. Okay, I call the economic risk. So we had to avoid, we had to avoid, but diversification of suppliers as well as customer, okay, could be one of the way we can attempt to reduce the exposure towards this risk. Okay. Question?
Question.
Ask Thomas.
In a case of economic risks, who suffers in case the currency of the home currency strengthen, exporter or importer?
It could be the US exporter, you're the one who suffer. Why? Because if, let's give you an example, okay, that you are a tea farmer, okay, you export, okay, to European markets, okay. So if, for instance, they're paying you 1 million euro, okay, that they're making to you. If currently the rate is equal to, let's say, 108 as it is, 108.5, okay, Kenya shilling per US dollar, okay, per US dollar, then the amount you want to be receiving therefore is how much? It'll be equal to 1 million times 108.5, you are therefore 108.5 million Kenya shilling, isn't it? Clear, Thomas?
Yeah,
On that?
yes.
Now, if the Kenya shilling becomes stronger, what happens to the rate? It moves from 108.5 to, let's say, 105. If that happened, therefore, it moved from 108 to 105 because the Kenya shilling becomes stronger, therefore the amount to be seen in Kenya shilling, therefore, is 105. Do you gain or do you lose?
You lose.
You lose, therefore, you're making a loss, therefore. That's therefore and a risk to you if you're going to be an exporter. If you're going to be an exporter, then that's going to be a risk to you.
Thank you.
Clear?
Yes, thank you.
Yeah, in case you're going, if you are a supplier, in case you are paying, if you're not receiving, you're paying, okay, your concern is case the currency becomes weak. Okay, if you're making payment, you're not receiving, like in this case, okay, you are an importer. Okay, you import material from external parties. An example, of just give a case of EABL, you import raw material, okay, from South America. Okay, therefore, if the currency becomes weaker, then you pay more. Okay, that's kind of your concern. Okay, therefore, cash flows will be decreasing. Okay, from the investment. Any other question? Another question, great. Then you have got the transition risk, okay, which I think I mentioned already. The case where the books of we have a foreign subsidiary, okay. The parent company has foreign subsidiaries investment, okay. So you want to tell, therefore, what should we do regarding the money that the company has, okay. Or rather, when it comes to transition of the books, when it comes to reporting the books of the subsidiary into the currency of the parent company, okay, don't forget they need to be, that doesn't happen, okay. And because the assets and liability, okay, as well as the equity, okay, the translation is done at a different rates, okay. The translation of the different accounts of the balance sheet, okay, they're done at different rates, okay. Some at the closing date, others at the average, okay, others are done at the date of the transaction. So there's so many to be used, so many different rates to be used along the way that we're going to end up with a case where the asset and liability are not equal, okay, like I mentioned, okay. We may have more assets than liability, okay. That becomes therefore gain to the company, or you have more liabilities than the assets, okay. Therefore, it can therefore loss to the company. We'll call transition gain and transition loss. However, as mentioned, this is not so concern. It's not a huge concern. Why? It is an accounting risk, okay. It is not in actual loss you're incurring as per se. It's just simply want to ensure that accounts of the company are balancing. Okay, so therefore have a case of having more of assets than liability, which becomes a gain to the company. Okay, or vice versa. You have a case of you having more liability than assets. Okay, therefore you have a loss you have incurred, transition loss. However, the concern is a bit low. Why? Because this is simply an accounting rather than cash based, okay, loss. Okay. Why? Because the books of their subsidiary were balancing before, okay, but because you're done the transition, therefore now they're not balancing. But it's not that you're paying money to ensure the balance. No, okay. And go through it. Yeah, then we continue. Okay, question? No question? Now, the next thing, the total cost is therefore the fluctuation, okay, between the exchange rate, okay, maybe like US dollars can shilling, okay, 108, okay, so a few months from now, maybe to be 103, okay, what? Because the fluctuation, okay. If we are to assume that we operate in free markets, okay, where there is no government control towards the rates, okay, like it happened in some other economies, I think China being one of them, where they control how the rates move, okay. In case of Kenya, for example, where the interference of the government is quite low, okay, then this can be some of the factor. But of course, the key factor is, of course, is the demand and supply, okay, the demand and supply of that particular foreign currency, okay. If you have more inflow, okay, for example, from the FDI, okay, foreign direct investment, okay, they come with the dollars, for example, okay, then definitely can becomes more of demand, okay, there's more supply of the dollars in the economy, that implies that for the rate have to go down, okay, so the force of demand supply has come in, okay, if you have more of import in the country than the exports, okay, that means therefore the demand more of the foreign currency, okay, than what it is demanded of their products, okay, then therefore they demand more, they're going to be paying, okay, since they are importing more, they're going to pay therefore more towards, okay, using the foreign currency. In case of Kenya, okay, we have more of imports than export, okay, or called the balance of payment, okay. Is that the case? Therefore, you have more of import, you demand more of the foreign currency. If your currency becomes weaker as time goes by, okay. In case you have more of import than exports, okay. And of course, you have, of course, the inflation, okay. What's the inflation in the market, okay? And of course, current inflation as well as what we expect, okay, can also be a factor towards the exchange rate, okay? Because no one will want to invest in a country where there's inflation, definitely, okay? So in case a country is experiencing more inflation, therefore there'll be loss of value of the money, there'll be loss of value of the currency, okay, compared to the other country foreign currency, okay. If the country experiences more inflation, more loss of value of money, less demand for the currency, therefore loss in value in the currency, okay. Case example, case of Zimbabwe, okay. I'm not sure that they still use their currency. They still use their Zimbabwe dollar, or it's gone. I think there's a time that they had converted to using the US dollar as their currency because of that hyperinflation in the economy. They still use their Zimbabwe dollar as their currency. Okay, so you guys, you don't even need news. So what do you do for life? Anyway, don't forget Zimbabwe dollar. I think they are yet to convert back to their Zimbabwe dollar, okay, because of that hyperinflation to an extent that the currency lost total value, okay. So they have to convert themselves to use another currency altogether, okay. And that's one factor. And because of the interest rates, okay, the interest rates in the economy, okay. We must say that in case the economy is going to be offering more interest rates, okay, if you're investors, what do you do, okay? If you have Tanzania offering, okay, 10% return, Kenya offering, let's say 8% return, okay, in case you're going to be an investor, okay, like international investor, where do you invest your money, okay, from that to other, assuming that all the factors remain constant, of course, invest in Tanzania because you're going to be getting more return for your investment as opposed to the case of Kenya, okay? Of course, you have the explanation of the economy. How do we expect the economy is performing? Okay, Kenya versus Kenya, Tanzania. Okay, this case of Kenya and Tanzania. Okay, so in case the Kenya economy is going to improve, okay, with time, okay, comparative wise, don't forget comparing, okay, comparative wise to Tanzania, okay, because therefore we do expect that here the game be things are going to the game be doing well. Therefore, the demand for cash sharing therefore improve, okay, in the Kenyan economy, okay. Therefore, the Kenyan currency will strengthen against the Tanzanian shilling, okay, if the economy is going to improve, okay. And of course, one of the measures of the economic improvement is of course inflation, okay. Okay, it goes back to the inflation. What do we expect of the economy? Okay, it's going to be happening. Another factor could be speculation, okay, in case there's element of greed in the economy, okay. And I think this was the case of Kenya in 2011, okay. I think even now it applies, but I think for 2011 it was a bit more, okay. We had a number of banks who came together to do what called holding of, okay, the dollar, for example, okay, the holding of the dollar, okay. So it happens, okay, that, okay, how is the market going to be reacting? Okay, those who are the key participants in the foreign currency market, okay, if they're going to be holding cash, the cost will happen the supply therefore is going to decrease. The demand remains constant, but supply is decreasing. They're going to be driving, okay, the foreign currency price upward, okay, for the sake of the short-term profit these banks want to make, okay. And of course, as I mentioned, the case of China, okay, where the government has their own policy and intervention, okay, Kenya, there's no policy, okay, the intervention is quite low, okay, if anything, okay, maybe the only intervention I've seen so far with the case of the Kenyan government, okay, is where they become participant, okay. I think in these years when it was doing too bad, okay, the government becomes a participant in the foreign market, okay, where they do sell directly to the market, the dollars, for example, okay, but quite rarely does it happen, okay. The case of Chinese markets, don't forget there's a bad, okay, I think it should be like 2.5%, 2%, I think it's 2%, okay. So this is what we call a band, okay. So they can't increase or decrease by more than 2%, 2.2% per day, okay. So between Chinese yuan and mostly the US dollar, okay. So if last even it was at 100, okay, it can't go beyond 1 or 2. Okay, that's the max it can go. Okay, it can't go below, let's say 2%, let's say 98 point something. Okay, so generally the case of government intervening, okay, towards the foreign market. So here's this government intervention that, of course, definitely they may dictate what to be the exchange rate. Okay, so all these are some factors that therefore may cause the exchange rate. And we shall attempt to discuss them in later on in theories. Okay, some of these factors and how they influence the exchange rate. So first theory, okay, to discuss the factors is called the purchasing power parity theory. Okay, the purchasing power parity theory. Okay, and this theory is based on the inflation differential in the two countries. Okay, and you see that in case you have a country where there's more inflation, okay, I think I just mentioned that right now. Okay, if you're going to have a country where there's more inflation, of course, no one wants to invest there. You don't want to lose the value of your money. Okay. So countries that have more inflation, therefore, will see their currency depreciating in value, okay, because the demand is low, okay. So in case you're going to have countries that are going to have lower inflation comparative-wise, okay, therefore their currency will be having more demand, okay. The demand of their currency will be greater, okay. The demand of their currency will be greater, okay. So then, therefore, when it comes to the inflation, okay, the more inflation experience in an economy, the lower becomes the value of that currency compared to the other country currencies. Okay, I think I've just mentioned the case of Zimbabwe. Okay, we have a case of having hyperinflation. Okay, inflation beyond the control of the government. Okay, then your money loses value definitely. Okay, no one wants to demand of your currency. Okay, therefore, the country, okay, I think I can conclude, the country that experiences a faster inflation, therefore, okay, will experience a depreciation in its currency, loss of value of their currency. There will be a loss of value of their currency. Okay, so country with more inflation, okay, therefore will be experiencing, therefore, reduction in the value of the currency depreciation. Okay. And of course, the opposite applies. Okay, countries that can have be able to contain the inflation, okay, will therefore be experiencing appreciation of the currency. That's as per the purchasing power parity theory. Okay. Question? An example. Okay, this is an illustration. Okay, let's go through it together instead of not a question. So if, for example, you have a case of, as you mentioned there, it is based on the law of one price, okay, that a commodity ought to go at the same price, even though in different currency, okay, the value, okay, should ought to be equal to the same. If, for example, you have a Kenyan shilling, okay, the price of this piece of bread is equal to 40, okay, it ought to be at the same price in the case of Uganda shilling, okay. So in Uganda, if the rate is 1 shilling of Kenya is 25 Uganda shilling, therefore the price in Uganda ought to be equal to 1,000, okay. So this is the law of one price, okay, that must be applying within those two economies. So in case in Uganda there's 10% inflation, then the price of the bread therefore need to increase, okay, by 10% to 100 to 100 because to 1100, okay, because there's 10% inflation. If in the case of Kenya, there's inflation of 20%, the price of the bread in Kenya ought to increase from 40, 20% times 40 to give therefore 48 Kenyan shilling. Okay, so based on the two, as you mentioned, that the law of one price. So since this is applying here, then we can say that 48 Kenyan shilling is equivalent to 1100 Kenyan shilling. Okay, that Kenyan shilling, that 48 Kenyan shilling is equivalent to, okay, 1100 Uganda shilling. Okay, would imply that for the rate, okay, of 1 Kenyan shilling per Uganda shilling, therefore 1100 divided by 48, okay, together therefore I think 22 together therefore 22.9 together shilling per 1 Kenyan shilling. Okay, therefore it is possible for us to estimate that in a year's time, okay, so this is 10% inflation per annum, okay, therefore in a year's time, okay, therefore this therefore will be the exchange rate applied in this particular economy based on 10% inflation and 20% inflation in Uganda, Kenya, respectively. I hope that was clear. Question? Okay, no question. So let's do an example. I guess we have an example. Okay. So anyway, from this example, okay, we can do what call to draw what we call the purchasing power parity formula. So you see that the rate to be applied. Let me just go back to it. Then to extract the formula, okay, that the 22.25 can be determined that the future spot rate, okay, or rather it's applicable in a year's time, okay, both is 10% per annum. But the big F with the terms used, okay, the term, is it 1 year, 6 months, 3 months, okay, how many days are they, okay? Say, for example, you don't determine what will be the exceeded applicable in a year's time, you can use the purchasing power parity theory, okay, which will be equal to the current spot rate, okay, which is 25, okay, times the rate applicable. In this quotation, it was you get a shilling, okay, per you get Kenyan shilling, okay, it was your GX, okay, we divide by Kenyan shilling, which was equal to 25 over 1, okay. Therefore, the price currency is you get a shilling, the base currency is Kenyan shilling. Therefore, the inflation experience in the price currency, which in Uganda is 10%, therefore 1.1. So 1 plus R, okay. We divide by the 1 plus the inflation experience in the price currency, this Kenyan shilling, which is 20%. We divide by 1.2 and get 22, and we get therefore 22.92. Okay, that would give for the future spot rate, which I think we obtained here already. Okay, therefore, we can use therefore the purchasing power parity theory to determine therefore what ought to be the future spot rate. Okay, therefore, because the future spot rate is equal to the current spot rate, it's not okay. 1 plus inflation, 1 plus the inflation experience. Okay, 1 plus the inflation, H being the inflation in the price currency, we divide by 1 plus the inflation experience in the base currency. Okay, therefore this is called the purchasing power parity equation. Okay, where F naught, okay, as for this formula is the future spot rate. S naught is the current spot rate, okay, that is today's spot rate. HP or the H, okay, with P, okay, is equal to therefore the inflation in the price currency, okay. Then HB there, okay, the inflation experience in the base currency. So you have to observe how is the quotation like, okay. So always pay attention to the quotation, okay. It's going to guide you what's the price currency and what's the base currency. What you have here in this slide. Okay, take a note. Okay, so that's on the purchasing power parity theory. Okay, so be careful because your examiner will give you this formula, okay, but it will appear as follow. Okay, that's how the formula will appear. Okay, of course with no captions on how to apply the formula. Okay, because you have to be able to know that, okay, what each of the term there applies. Okay. Okay, actually I ought to have used S1, okay, as my in the equation, not F not, because F applies forward. Okay, so take note of that. So in my equation here, let me just go back a bit. So this is not meant to be F naught, okay, it should be S1 because F naught applies to forward rate. So let me rub off this. Okay, so it's meant to be S1, spot rate in future. So this is one of the formula that the examiner will give you, but nothing else. The way just this is how it will appear in the exam. Okay, so you should be able to tell that this is the purchasing power parity theory formula. The finished spot rate is equal to the current spot rate. We multiply by 1 plus the inflation experience in the price currency. Okay, we divide 1 plus inflation experience in the base currency.
Question.
Yes, sure.
Now for this case, the best is it the best currency the one with the high inflation, or how do you determine that this is the best currency?
No, there's no best currency or there's no worst currency. Okay, let me just go back to this example we did. But in terms of appreciation and depreciation of the currency, we see that the currency is depreciating. Because if we are to observe, this is the exchange rate after an year. Before it was 25, isn't it? Thomas, this
Yes,
was the
yes.
rate before.
Yes.
And this is the rate after. Now, all that means that the Kenyan shilling is becoming weaker. Why? Because, okay, one Kenyan shilling before was equal to 25. Okay, one Kenyan shilling was equal to 25 Uganda shilling, isn't it?
Yes.
Now, the same one Kenyan shilling is now equal to fewer currencies or units of currency in Uganda. Can you see that?
Yes.
Yeah, so we conclude that the Kenyan shilling is depreciating and becoming weaker compared to the Uganda shilling. And vice versa. That Uganda shilling is becoming stronger, okay, compared to the Kenyan shilling. Yeah.
Yes, yes.
Okay, great. Okay, let's apply this formula. I guess I should have an example somewhere. Mm-hmm. Is this? Only that. Okay, we can do this. Okay, so go for it. Okay, first make the attempt. Let me see how far you can go. Munir, what do you have?
4.63.
4.63. 4.63. Okay. There's a estimate. Okay. 1 plus inflation experience in price currency, 1 plus inflation experience in the base currency. So we got current spot rate is equal to 4.5. In the quotation, it's the quotation is in dollars to pound, so it's dollar to pound. Okay. Therefore, the price currency is the dollar, and the inflation in the dollar is equal to 6%. Therefore, times 1.06. We divide by the free experience, 1 plus the free experience in the base currency, the pounds, which is equal to 3%, 1.03. You get 6.3. Munir. 4.63. Okay, great. Together for the spot rate, to be the fiat spot rate, therefore to be equal to 4.63. That's as per the purchasing power parity theory. Limitation, I think you can go through it. Okay, there's limitations. I think you can go through this for sure. Next, we discuss another factor that was that explains the exchange rate, which is called the interest rate. Okay, when we encapsulate as the interest rate parity theory, the interest rate caps theory, the interest rate parity theory. So let's see that if you're going to have an economy that is going to be experiencing, or be offering, okay, that's time that an economy that will be offering higher interest rates to the investors, okay, the investors, therefore, we want to invest in that country, okay, where there's more interest, okay. In case you're going to have a case of Tanzania offering more interest rates, what do? You invest in Tanzania because they're offering more interest rate for my return, for my investment, okay. Therefore, the country, therefore, that will be experiencing, therefore, greater, okay, will be offering greater interest rate, okay. Therefore, there'll be more investment for that country. However, the market will have to act against that, okay. The market will have to ensure there is no any chance of a person getting what we call a beaten profit. Okay, there's no the investors, whether in Kenya or whether you're going to be in Tanzania, the total return will be said. In case you're a Kenyan investor, you invest in Kenya, and an investor in Kenya, you invest in Tanzania because Tanzania is offering more interest rate. We have to ensure, the market have to ensure that once you convert the Tanzanian shilling you receive, the interest you gain from Tanzania, convert them back to Kenyan shilling, the return to be received will be the same. Okay, so it does not make sense, in quote, okay, for a Kenyan, let's put it that way, to invest in Tanzania, because whether you invest in Kenya or in Tanzania, the return will be getting, if you convert your Tanzanian income back to Kenyan shilling, will have to be the same. Okay, this is as per this theory. Okay, that the total interest, the total earnings to be received by the investor in whether in Kenya or in Tanzania must be equal. Okay. So since we have, as we have said, that the Tanzanian shilling will be more of demand because they're offering more Kenya shillings, they're offering more interest income to the investors, for example, we have to ensure that the future spot rate, okay, don't forget the investor, what the investor might do to ensure that they lock in the potential interest to be earned in Tanzania is they enter into an agreement with the bank that, hey, in a year's time, I'll be getting X amount of interest that I'll be earning. Okay, so in 3 years' time, not in 3 years, in a year's time, for example, okay, I'll be receiving maybe 10,000 Tanzanian shilling, okay, in form of interest income. So I agree with the bank today that, hey, we need to enter an agreement that in a year's time, I'll give you Tanzanian shilling, okay, you give me Kenyan shilling, okay, because I'm a Kenyan investor, okay, input my Tanzanian shilling as per se, all I wanted was to make interest income, okay, so I have to convert back to Kenyan shilling, okay, because I'm a Kenyan investor, okay. Now the market will ensure, okay, that the forward rate to be given, okay, that will be applied in 3 years' time, in a year's time, will ensure that there is no any extra profit you earn over and above what the local investor will be earning. In short, therefore, the country that will be experiencing, that will be offering higher interest rates, okay, will see their future spot rates, their future, we see their forward rates, okay, depreciating to counter against that extra income they want to gain. Okay, I hope that's clear. Okay, the country that will be offering a greater interest rates, okay, okay, will have to see their forward rates, okay, it has to depreciate, okay, In this case, therefore, the forward rate between Kenya shilling versus the Tanzania shilling, okay, there'll be a depreciation on that forward rate. Why? Because the investor who did invest in Tanzania, they make extra return. But as I mentioned, the market will ensure that they wipe out that extra return by account going against that. Okay, therefore, the forward rate will have to depreciate. Okay, currency, the country that will be experiencing how they'll be offering higher interest rate to the market. Okay, therefore, their forward rate, not the spot rate, their forward rate. Okay, therefore, will be depreciating. Will be going against that. We'll have to depreciate in order to ensure there's no any extra income to be earned by the investor. That's the interest rate parity theory. Interest rate parity theory. Okay. Okay, I need to go through that note, to go through the slide. Okay, so that's on the interest rate parity theory. And generally, the interest parity theory says that the forward rate, okay, therefore will be equal to the current spot rate. Okay, the forward rate will be equal to current spot rate, 1 plus the interest rate. Here the I is interest rate in the price currency, plus 1 over interest experience in the base currency. Okay, there is the interest parity theory. Okay, the fear spot rate. The spot rate is current spot rate. Current spot rate, okay, 1 plus I. We have the I for the numerator is for the price currency. The same way the quotation is done. Okay, the price and the base currency. You just follow how the quotation is being done. Okay, you do 1 plus the interest experience in the base currency. And as mentioned, okay, the country that is going to be offering the higher interest rate will see the forward rate. We'll see the forward rate depreciate its currency depreciate. Okay, so you have to go. It has to go against okay what the interest is saying. Okay, because the country that will be having the higher interest rate will be having high demand for the currency, but the forward rate have to go against. Okay, you have to counter that. Okay, therefore the currency therefore must depreciate. Clear? Question? No question? To an example. Okay, make the attempt first. Let's see how far you go.
Previous page a little bit, please.
Okay, there you go. This one.
The previous one I'm still writing.
So this one or the other one?
The one with the formula.
Okay, it's on the screen. Can you see it?
No, I'm seeing illustration only.
Hey, what is gone slightly behind? Now I don't know. Let me just escape this full PowerPoint mode. Let's see.
Yes.
This one?
Yes.
Okay.
Yes, thank you.
Okay, let me know once you're done.
Yes, sir. Just moved again.
Hey, what's happening?
The previous one.
So you want the one that has the formula?
Yes.
And that's where my screen is.
Just come back, yes.
You just come back.
Yes.
Okay.
Up a little bit.
What's happening? So I've done nothing. So can you see the screen?
Yeah.
Because I don't.
Yes.
Is it clear now?
Yes.
Okay.
True.
Okay, great. So attempt this question. So make the attempt in this and see how far you can go. Mercy, what do you have? Mercy? We can't hear you.
I said I'm stuck.
Oh, you are stuck. Hey, okay.
Yeah.
Okay, John. Sorry, Mercy. John?
Still not yet.
Okay, Teddy.
I've gotten 2.4.
2.4. 2.4%. Okay. Thomas, what do you have?
6.92.
6.92. Brenda, what do you have?
7.41.
7.41. Okay, Janice, what do you have?
92.
Sorry?
6.92.
6.92. Munir, what do you have?
I'm stuck.
You are stuck. Okay. Let's do it together. Okay, so in this example, we'll be given we have been given two countries. Okay. Okay, let's attempt it together. Okay, so we're given here two company, the spot rate. So we're given the interest rate, the 90-day forward rate. Okay, you mean us to get what is the implied interest rate in Southland. Okay, okay, we need to get the first forward rate is equal to current spot rate. Okay, 1 plus the interest experience in the price currency, 1 plus the interest in the base currency. The quotation, okay, okay, here the two quotation given. Okay, one is direct, the other is indirect. Okay, so you can use one of them. Okay, so let me use the first one. Okay, therefore the current spot rate is 4.725. The quotation is NF to the dollar. Okay, it's NF to the dollar. Therefore, the interest rate in NF, the NF with the north side is 7.5% annualized. Okay, is equal to 7.5%. Okay, per annum. However, don't forget this is a 90-day forward. Is a 90-day forward. Okay, therefore we need to convert this rate from being per annum to 90-day. Therefore, to be 7.5% times 90 out of the number of days in a year, which is equal to 65. And kilos how much? 1 point. 1.85%. Okay, therefore 1 plus 0.085. 1.0185. We divide by 1 plus the interest experience in the base currency, which we are being asked to get. The forward rate, the 90-day forward rate, okay, is equal to 4.7506. Therefore, we'll get the interest rate. Therefore, okay, simply just divide and multiply. It will be equal to the interest rate. Therefore, will be equal to the interest in the base currency. In this case, this is the country with the dollar is equal to 4.725 divided by 4.7506. Okay, we'll say 1.0185 minus 1. And you get how much? 1 point. 1 point.
3.
1 point. Sorry, 1 point. We get 1.3%. Okay. And that is it, 1.3%. Okay. In case you want to annualize it, okay, the annualized return, 1.3% is for 90 days. What about for these 5 days? With this 5 divided by 90, in case you want to annualize it to give us 5.2%. That's what you're meant to do. As I mentioned, don't forget, you'll be very careful with the terms, okay? Is it a 90 day? Is it an 80 day? How many days do you have? That you have to be quite careful, okay? You convert, in case they are per annum, use per annum. If they're 90 days, convert all the rate into 90 days period. If 180, 180. So be careful with the term. Clear? You can also use the second quotation in case you prefer. There's no real difference, okay? You can also use the second quotation, no difference at all, okay? Because the quotation, one is can be direct, the other one is indirect, but no difference at all. Okay. Question? Okay, no question. That's on the interest purchase. That's on the interest purchasing Parity theory. Okay. It is possible for us to use the interest purchase power Parity theory to determine the future exceeded. Okay, that it is possible. That sometimes you notice that it is possible for us to use the interest rate as the unbiased predictor of the future spot rate. Okay, but it is possible, okay, to use the forward rate, okay, as the unbiased predictor of the future spot rate. Okay, therefore, the future exceeded rate can be predicted using the forward rate. Okay. The assumption that we're making here, okay, the assumption is that at the end of the day, okay, it is possible, or rather, the forward rate you can be obtained from this, the forward rate to be obtained from this theory that can be used as the predictor of the spot rate, okay, the future spot rate, okay, that's what they're trying to assume here, okay, but the forward rate, okay, the one you just obtained from the interest rate by theory, they can be used as the unbiased predictor of the future spot rate, okay. So this statement I want to explain here, okay, is going to be used when explaining another theory, okay, which I think I'll mention this alone, okay. It's possible for us to be able to determine, therefore, what ought to be the future spot rate, okay. So if we are to rearrange the equation, okay, for the interest rate parity theory, okay, forward rate was given us current spot rate 1 plus interest in the price currency 1 plus the interest in the base currency, okay. We can say therefore that if not, okay, we can simply convert it from this to this by simply dividing S naught, that is the current spot rate, on both sides. Okay, that the difference between the current spot rate, the difference between the current spot rate, okay, and the forward rate, okay, is equal to the difference between the interest rate experienced in the price currency and the base currency. That's what to mean. The difference between the current spot rate and the forward rate is equal to the difference experienced in the interest rate in the price currency and the interest rate in the base currency. Okay, by simply rearranging this equation. Okay, this is an assumption. Okay, this is an assumption that we're making. So next theory, okay, I'll come back to this theory later on. Okay, the next theory is called the theory of expectations. Okay, the theory of expectations. Okay. And we had mentioned regarding expectations in one of the factors that influence the exceeded. We said if we are going to be expecting the market to be performing well in this particular economy, okay, Kenya perform well than the Tanzania shilling, than Tanzania economy. Of course, therefore, Kenya shilling will be appreciating value compared to the Tanzania shilling. Okay, I think we had mentioned that. Okay. That in case we have a case where we have more inflation, okay, being experienced, if we expect that there'll be inflation in the Kenyan economy, okay, would you want to invest in Kenya? No, invest in where there's less inflation, less loss of value. In this case, for example, in the Tanzania, okay, they call the theory of expectations, okay. If you see that at the end of the day, the forward rate, okay, can be used as unbiased predictor of the future spot rate. The forward rate, okay. The forward rate that we experience can be used as unbiased predictor of the future spot rate. Okay, that's what we just discussed. Okay, If that's not the case, therefore, where if it is not possible, or if that cannot be the case, then of course, therefore, there'll be chances where there could be arbitrage occurring. Okay, I think we have discussed that already. Okay, that we have, or the market will have to react in such a way that as an investor who invests in Tanzania, where there's more return to be received, okay, we have to ensure you don't get that extra return, to be received. Okay, we mentioned that, we did mention about that. Okay. In practice, in no case, the forward rate, the future spot rate are going to be very different. That's going to be the reality. Okay, but in theory, okay, we assume that it is possible for us to use the forward rate as the unbiased predictor of the future spot rate. Okay, which imply therefore, if this is the case, that the forward rate can be used as the unbiased predictor of the future spot rate, don't forget the forward rate is being explained by the interest rate. Okay. The future spot rate is being explained by the rate of inflation. Okay, we should remember the purchasing power parity theory and the interest rate parity theory. Okay, which implies therefore you can use therefore the interest rate differential between the two countries to explain the future spot rate. Okay. In short, you're trying to make or equate, okay, the purchasing power parity theory to be equal to the interest rate parity theory. Okay, that's what we are trying to attempt in this theory. Okay, don't forget the future spot rate, the forward rate, okay, was explained, okay, by the interest rate differential, interest rate. The spot rate, okay, the future spot rate was explained by the inflation rate differential. So as for this theory, we are trying that it is possible for us to use, therefore, the interest rate differential to explain the spot rate. Okay, we can see how they're combining. Okay, that we can also use this to explain this, and this to explain this, in short. Okay, but it is possible for us to have the two theory, okay, coming together. Okay, under the theory of exploitation. And also, we can also explain the inflation rate differential, to explain the forward rate. In short, the forward rate can be used as unbiased predictor of the spot rate. Okay. I hope that's clear to understand. That's as per the theory of expectation. And so you're trying to equate the two theories together, okay? The purchasing power parity theory and the interest rate parity theory. Clear? Question? Your class is amazing. No one has questions. Okay, it's good. It's a good sign. The next theory is called the Fisher's effect theory. The Fisher's effect theory. Okay, so we go back to the Fisher's theory. Okay, the Fisher's theory, which we discussed under how to appraise investment in the case of inflation. How we should know this formula. Okay, we say that at the end of the day, okay, the interest that will be received as a holder. Okay, therefore, you must get premiums. Okay, you must get premium if you're going to be exposed to any inflation risk. Okay, that the nominal interest rate, okay, therefore to be received by the holder must take into account, okay, the inflation that will be experienced in that particular economy. Okay, which therefore we say that given us, okay, the nominal interest rate, this is the nominal interest rate, okay, 1 plus the nominal interest rate is equal to 1 plus the real interest rate, okay, we multiply by 1 plus the inflation experience in that particular country. Okay, what imply therefore, okay, what you want to mean, we have expand this alone, is that if you invest in Tanzania, okay, where you're going to be getting more return, more interest rate, the only reason we're getting more interest rate is because there's more inflation. Okay, that's what we want to understand from this theory. Okay, that if you're going to invest in Tanzania, where Tanzania is offering more interest rate, the only reason that they're offering more interest rate is because there's more inflation. Okay, the only reason why Kenya there's less interest rate to be received or less interest income to be received is because there's less inflation. Okay, that's as per the Fisher's effect. That the return to be received, or rather, the real return to be received. Okay, the real return to be received by the holder. Okay, whether in Kenya or in Tanzania, must be the same. So any economy offering you more interest rates is because there's more inflation that you'll be experiencing in that particular economy. Okay, that's as per the international Fisher's effect. Okay. that if you invest in Tanzania, you get 10% return. Okay, it is because Tanzania has more inflation. That's why they're offering you more interest rates. Okay, the country that offers you less interest rates is because they're offering you lower interest rates. Okay, because it's lower rate of inflation, which you'll be experiencing in this particular economy. That's as per the international Fisher's effect. Okay, arrived at from the international Fisher's effects theory. Therefore, argues that the nominal interest differential between the two countries is going to be therefore unbiased predictor of the fiat spot rate. Okay, what do you want to mean that is that? Don't forget here. Okay, the nominal interest rate, you see that this is unbiased predictor of the fiat spot rate. This is because the spot rate, okay, which we say is equal to S1 is equal to S0 1 plus inflation in the price currency, 1 plus the inflation in the base currency. Okay, that the fiat spot rate is explained by the inflation differential in the two countries. And since now the nominal, okay, since now we say that the difference between the interest rate between the two countries is because of inflation, we can use therefore the nominal interest rate to explain the spot rate. I hope it's clear, okay? That's the two countries, okay? We have, let's say, Tanzania, Kenya, okay? Let me call this Tanzania, and this is Kenya. Tanzania offer 10%, Kenya 8%. The difference between the two is because there's more inflation. If you look at the side of inflation, for example, the inflation in Tanzania will be, for example, let's say at 3%. In Kenya, let's say 1.5%. Okay, the difference between the two, then the interest to be offered between the two countries is because of the difference in the inflation. So since we can now be able to tell that the difference in the nominal interest rate in Tanzania and Kenya is because of the inflation differential, then we can use it for the nominal interest rate to explain the future spot rate. That's also the international Fisher's effect theory. Clear? And take a minute to go through it. Okay, suppose you've gone through it. So since you see that as per this theory, okay, it is possible for us to be able to explain that the difference in the interest rate being offered between the two countries, okay, that's Tanzania and Kenya, okay, is simply because of the difference between the inflation rates, okay. Therefore, the interest differential in the two countries, that is Tanzania and Kenya, okay, this is the interest differential, okay, is equal to the inflation rate differential in the two countries. Okay, that's as per the international efficiency effect theory. Because this makes sense, that country that are going therefore be having higher rate of inflation, therefore must give or must compensate the holders or the investors to higher nominal interest rates and vice versa. Of course, that makes a lot of sense. The assumption that we're making here is that the two countries are offering, okay, or they have value return to the investor is the same, okay? The value return to the investor is the same, which implies therefore the difference in the interest rate offered by the two countries is purely based on their inflation rate differential. It is possible for us to combine all those theory into one, we'll call the four-way equivalency theory. Okay, the four-way equivalence theory. Okay. And this theory says that at the end, when it comes to that it is possible. First, if you have to base, let's begin by having what we call the purchasing power parity theory. Okay, what we call that it is possible for us to determine what ought to be the future spot rate. Okay, that it is possible for us to determine the future spot rate based on the inflation rate differential. Okay, we have it here. Okay, this is the purchasing power parity theory, more or less. Okay, that it is possible to explain the change in the future spot rate based on the change in the inflation rate. Okay. This therefore is our this therefore is the purchasing power parity theory. Okay, power parity theory. Yes. Okay, the rate, the difference between the inflation rate, okay, can be used to explain the spot rate. Okay, I think you mentioned that. Okay. Then, as per the interest rate parity theory, okay, we said that the difference between the interest rate in the economy, the difference in the interest rate in the economy, okay, can be explained, or they've changed. If you have to make a comparison between the forward rate and the spot rate, then this can be explained by the interest rate differential between the two countries. Okay, we call this the interest rate parity theory, the interest rate parity theory. Okay, we have it here, which we will explain together. Then, as per the theory of exploitation, okay, let me just take you back. Okay, the theory of exploitation. We see that the forward rate can be used as an unbiased predictor of the future spot rate. Okay. Okay, that the forward rate, okay, can be used as an unbiased predictor of the forward rate. Okay. Now it is possible for us to combine to see that the difference between the interest rate, is equivalent to the difference in the inflation rate in the economy. Okay, the difference in the interest rate, okay, is equivalent to the difference between the inflation rate differential between the two countries. Okay, so let's go back to this theory, the four equivalence. Okay, the difference in the interest rate, okay, which you have it here, okay, is equal to the difference between the inflation rate differential in the two countries, which you have it here. Interest rate differential, okay, is same as the inflation rate differential in the two countries, which you have it here. Okay, is a theory of exploitation. Okay, exploitation theory. Okay, they call it the ET. Okay, we have to see that at the end of the day, okay, when it comes to the spot rate, okay, and the forward rate, okay, but it is possible for us to be able to predict, okay, what will be. Let me just go back. The interest rate, okay, this is the interest rate between the country. The forward rate is equal to current spot rate, 1 plus the interest in the price currency, 1 plus the interest in the base currency. Okay, we see that this is given us F naught divided by S naught is equal to 1 plus the interest in experience price currency 1 plus interest experience in the base currency. This can be explained, okay, by the difference between the inflation rate differential. Okay, if you remember, you see that this is also equivalent to. Let me take you back to the internal affairs equation. We have it here. Okay, so let's bring it here. Is equal to therefore 1 plus 1 plus. Let me just rub off some things here. Okay, my space is not the biggest of space. Let me just squeeze it here. Okay, forward rate divided by spot rate is equal to 1 plus the interest rate differential in the price currency, the base currency, which is equal to, okay, 1 plus the inflation, okay, in the base currency. Okay, let me call this H, the inflation, price currency, 1 plus the inflation in the base currency, okay. That we said, which therefore will also be equal to, if you remember, under the interest parity theory, okay, this is equal to the S1 divided by S naught, okay, that we can use the rate of inflation differential to explain the fiat spot rates, okay. So this is the purchase power parity theory. Hope you still remember this is a purchasing power parity theory, okay. So since they're the same, therefore, we can say we can equate it so that the difference between the forward rate and the spot rate is equal to the difference between the spot rate and the forward rate, the current spot rate and the fiat spot rate. These two, this one and this one. Oh, I hope you can see. Let's use a different ink here. So this one and this one here, and this is what you have here. Clear? And lastly, we can say that the difference between the spot rate, okay, the spot rate, the current and the future can also be explained, okay. This normally is this ink, this one can be explained by the change in the interest rate, which therefore what I want to mean by that, let me up of this. That's 1 plus the interest rate in the price currency, this one here, 1 plus the interest rate experience in the base currency is equal to the change in the spot rate, current spot rate, the future spot rate, we do a current spot rate, okay, which I have here, which I have it here. The change in the spot rate, okay, change in the spot rate here is equal to the interest differential in the two countries, which I have it here. Let's call the four-way equivalence theory. The four-way equivalence theory. You should be able to explain it, okay? Because the examiner is going to ask you explain the four-way equivalence theory. It's trying to bring all those theories, okay, into one theory. Okay, all of those theories into one theory. Munir, it's clear? Is it clear, Munir?
Yes, it's clear.
Okay, great. John, is clear?
Yes, it's clear.
Okay. I know you're just saying it's clear, okay, but I propose that, okay, take your time to go through those notes again, okay, because it can be very confusing, okay, especially in case you're being asked to explain a theory, okay, I propose, okay, for your own sake, try to go through those notes again, go through those notes again, get to know all those theories in detail, because you'll be asked to explain them, okay, and one of the theories that students normally fail is this theory, the four-way equivalence theory, okay, most of the time, students don't get it. Okay, even the main exam. So I suppose, okay, I suppose you're going to go through it again, okay, for your own sake. Understand the theory quite well. Okay, the theory that attempts to explain the difference with the exchange rates, between the exchange rates, okay, between the home and the foreign currency. Okay. Now, how do we manage foreign currency risk? Okay, so just brush over here how to manage the foreign currency risk. A number of ways we can manage. Okay, there's invoicing your home currency, for example. Okay, that's an easy way. Okay, because in case, for example, you're a Kenyan company, if you invoice your customer in Kenyan shilling, Therefore, the exposure is to your customer, not you. Okay. Therefore, that's a way of trying to manage your foreign currency risk. Invoicing in your home current currency. The leading is if you're pay in advance in case cash, if you can foresee in quotes, okay, that cash is going to become worse off as time goes by against the dollar. Pay in advance, okay. That could be one of the way. Okay, pay in advance. In case there be expected that cash is going to depreciate over time. Okay, pay in advance. Okay, lagging, wait. Okay, if it is possible for you to wait. Okay, if a customer pays you today, okay, maybe a customer will pay you in a month's time, but by then the cash will be too strong. Okay, to an extent that if you had waited for next 1 month, okay, we could have been able to obtain more money. Therefore, don't, even if you receive, don't convert. Okay, wait until maybe that time, the point in time when the cash shell is in quote a bit weaker. Okay, because you are receiving, you are an exporter. Okay. So that once you go to the market, you convert at higher rate. Good call, lagging, waiting. Okay. So because of the case of matching receiving payments. So in case, for example, you do have, okay, an investment, okay, where customers, foreign customer, they pay in dollars, okay, and the raw materials, okay, they also bought in dollars, okay. One of the you can try to reduce on that risk of foreign currency is in case you can match the receipts and payment, okay. But the receipts in dollars, okay, you match the payment you make in dollars. If you do that, there's no any risk. If you can match those two. Don't forget the risk comes in case you have more of receipt in dollars, okay, than the payment, and the vice versa, okay. But in case you have the dollar and the positive dollars in terms of receipt and the negative dollars now the payment, they match, they end up with a zero in terms of the exposure towards the foreign currency risk, okay, matching of receipts and the payments. If you can do that for sure, okay. That will make therefore the work a bit easier, okay. Then another way you can try to manage the foreign currency risk, okay, is the use of matching asset and liability. If that will be possible, you match the asset of the subsidiary, for example. Okay, if you're a subsidiary, you match their receipts and their liability. Okay, those assets that are exposed towards the foreign currency rate movement and the liability, you match them. Okay, if that can happen, therefore you end up with a zero translation risk. Okay, you end up with a zero translation risk by matching of the receipts and the payment. Another is about netting. Okay, so in case we are two companies, okay, we have in quote good relation. Okay, if I owe you money, okay, you are a UK company, okay, UK company, okay, and you owe me this. Okay, so they're in dollars. You owe me $10 million. Okay, you okay as a Kenyan company. So this is a receipt to the UK company. Okay, this is a receipt. Okay, so you as a Kenyan company, okay, I owe you, okay, as UK company, okay, one of your books, in your books, okay, you have here, you have receivable here, okay, from this UK company, okay, equal to, let's say, $5 million, okay, you can see the net of the amount, okay, that, hey, I owe you owe me 10 million, okay, I owe you 5 million, okay, instead of us paying, receiving, okay, we have so much exposure. Why don't you just net of the amount, okay? Therefore, you pay me $5 million, okay? The difference between the amount that you owe me, okay, and the amount that you owe me. Issue that we are trying to reduce that the amount that is exposed to the foreign currency risk, okay, by simply netting off the amount, okay. All of this must only apply in case the two of you have some good terms, good relation, okay. For example, the case of the multinational companies, okay, that might make things a bit easier, okay, between the parent company and the subsidiary. But the case, but if it is possible, even not to have an MNC, okay, do that, it might make your work a bit easier, okay. So you as UK company, okay, therefore your exposure is only to us. Your exposure, you don't have any exposure by you as UK company because you are receiving money. Okay? You as a Kenyan company, you have reduced your exposure from 10 million, okay, to 5 million by simply netting off the receipts and the payment, the payables and the receivables, in short. Okay, so that's some of the ways that you can use to manage your foreign currency risk. Now, I don't want to introduce the hedging techniques, okay? So therefore, the next time we meet, we discuss what are the hedging techniques we can use, okay, to manage your foreign currency risk. Okay, so therefore, next time we meet, we start off by discussing the hedging techniques. Okay, and I suppose that you're all going to be there because in case you miss a part of the class, then you'll find it hard for you to do any question. Okay, when it comes to how to hedge on the foreign currency risk. Question?